Alright, good afternoon, good evening, all. All depends on when you're tuning in. This is Trading Made Simple with FXME. So I'm going to drop some more knowledge again, some more free value. The value you give out is what you get back in return. I strongly believe in that. So I believe this knowledge has been given to me, and I believe everyone should know it because it has been life changing in so many ways. And but let's get into this. But before we get started, so if you wanna join our free channel, I'll drop the link in the description, and then you can just follow us here if you want to. I always drop knowledge here, trade ideas, um, knowledge content as well. So, and if you want to connect with me personally, you can hit me up on Facebook, Jevin Farrell, or on IG, Jevin_Farrell. So let's get into this. So what I'm going to explain today is the quarters theory. Now, if you follow Steve Morrow and the market making method, you should know that the moves happen at the highs and lows, meaning that Steve says this in one of his um, educational videos where he explains the whole business in a nutshell is the high and low of the day, if you're a day trader or intraday trader, what you're going to call it. So moves happen at the highs and lows of the day, highs and low of the week, highs and low of the month, highs and low of the year. But there's another concept Steve doesn't mention, which is the quarters theory. Now, some of you guys might be familiar with this, some of you might not be. If you're not, you're in luck. That's why I'm here. Now, you all see that we all know that each annual has 4 quarters. First quarter is from the 1st of January up until the 31st of March. The second quarter starts in April. So, as you can see over here is the 1st of April on this candle. And here's the first quarter. Now what I'm gonna do is I'm gonna break this down quarter by quarter, okay? And then we're gonna look at the whole at the bigger picture. Now first of all, what does Steve say? Market makers make fake moves beginning of the session, end of the session, beginning of the day, end of the day, beginning of the week, end of the week, beginning of the month, end of month, beginning of the year, end of year. And same thing. Market makers make fake moves beginning of the annual, beginning of the quarter, and end of the quarter. Now, as you can see over here, this is the beginning of the new year, basically. And we see that market makers basically a railroad track to the blueberry over here. This is obviously to pick up some orders and snatch them away. Now, also, if you were trading from last year, you would know that this is basically you're coming from a bearish cycle, or this was a bullish cycle. It's obviously the 1, 2, 3 levels of rise, reversal information, 1, 2, 3 levels of drop. Now, you can also see that you have head and shoulder formation, kind of. If you're taking it into the border upside. Now, what happens is, now remember, you should always highlight these lines. Now, first of all, what I do is I always tell my students this: use a line chart. So when you do that, is once you have a line chart and you move my pad, once you put it into a line chart and you have your peak formation low and switch to candles, you have wicks. Now those wicks can come in handy because a wick is basically where market makers cause some damage, meaning that stops will hit over here. So look at this pin before they pull away. I mean, this is a daily time frame. It's a lot of money. This is literally, that's 120 pips, 130 pips in one day. So you can imagine some people were panicking on the 9th of January. Now, this is your low of the year. Obviously, you can see, like I said, in the line chart is even better for level counting. So as you can see, the information low. Now, if we go to a 4-hour chart, might be able to see more clear. So another gem I want to drop on you is, if you're counting levels, I always use the 4-hour and 1-hour time frame to analyze my charts for my page. Reason being, I always want to have a macro perspective. So if I know a long-term trend is going to be bearish, I know I should be looking for sales. And if trend is bullish, I'm down looking for buys. Now, as you can see, we have, as you can see, beginning of the year, you can see that they printed a mayor with the information and they give us a stop. Now, to a breakout, to a retail trader, this is basically a breakout. Remember? So remember, if you also implement the TDI over here, you can see that we actually have a sharpen. Okay. And apart from that, if we go back a little bit further, I thought we had some divergence over here, but not really, not really. Anyway, so like I said, so this is the whole annual line chart, and here you can see you have your level one rise, consolidation, 1, 2, 3 pulls, 1, 2, 3 impulse to the upside, level two consolidation, and here you see once again you have 1, 2, 3 pushes to the high, and here they give you that macro information and they pull away again. Could have sold from here, bought back to the high, either way. So that's a simple way of analyzing. Now back to the daily. So as you can see, this is low of the year. Now you always going to have to highlight this point as well because this is the high of the annual. And remember, everything didn't exist yet in time. So if this is your high, this is your high. So you have to wait until price either comes back to this point or this point because that's where most of the volume will be. And look what you have over here. So the second quarter started on the 1st of April. It ended the 1st of July. 1st of July was is the 1st of July. And you kind of see this breakout over here, which is kind of fake because once again, if you go to the 4 hour and see something different, I bet you might see a W formation. That's obviously a double impulse, level one consolidation, 1, 2, 3 impulses for level two. But this is kind of level two, and here's your peak formation high again with information. So simple trade, simple trade. So from this point on, this is what we can do since this is the new high of the year. This is our peak formation high. And obviously it's level three consolidation. Now here we see a crossover of the ketchup and the water. So that tells us that our level one consolidation or level three our peak formation high is basically locked. And if we zoom in over here, you can see that kind of have 1, 2, 3 impulses, consolidation. And then here we see once again we have a breakout and it's 1, 2, 3 below. See market held this level. Market held this level over here. Now, usually what happens is, so for those of you who don't know, the characteristics of the levels is when you in level 3 P accumulation high or low, the EMAs will be fanned out. You'll either have an MOW, and then level 1 consolidation is usually a straightaway trade, not long consolidation. Level 2, on the other hand, is always the longest consolidation, and you always have some type of pattern. Now, what I mean by pattern is level 2 is basically an inducing trend. An inducing trend because this is where retail traders basically trade in, and this is the type of patterns I'm talking about. Which means, in a retail perspective, this is support from 19 whatever they want to use, and now it's bouncing off support. So, but we know that level 2 consolidation is always longest consolidation. There's always some type of pattern involved. And then obviously, like I said, patterns as well. And look over here from this breakout, instead of Mayo basically, put some candles on there. We have information, and one more thing, look how this is basically as well. This is 1, 2, 3 pushes as well to the upside. And look, as they break this point, they give you 1 impulse, 2 impulse, 3 impulse, or you can see it as 1, 2, 3 from the breakout at this point. Now you can see that they basically extended the low of the year, which was actually a stop hand level beginning of the year. But look how they basically just rejected the zone, give you railroad track information, and you can also see that in the TDI there was some confluence. It showed you that something is about to happen with the shark. And this is something I've noticed in the TDI. If they give you, if they basically give you a shark fin and 3 hits looking like a W, just believe there's a reversal coming. Now, like I said, always use a line chart, and then you can see we have our pre-formation low. Then obviously they give you a nice W formation. Now, if you look at it from this perspective now you have a more clear understanding what's going on. So once again, you can basically count this as 1, 2, 3 levels of rise, and look how they basically give you information here as well. Now, keep in mind, this is the beginning of a new annual. The next annual starts on the 1st of October. So at the moment, we're in the third quarter, and this is obviously a market reset. Everything over here. Now, if this is an M reset, that could potentially mean that if they don't hold this level, there's either two potentials now. It's either they better hold this level at this point, and look how they just rejected this point when they started getting you have one wick and you have another three candles, three vectors. So the next potential move could either be they bounce from this point and go up to the upside and hit the water, depends on what the TDI. I doubt it. I doubt it. I think they're gonna break this level. I definitely think they might break this level. So that's the quarters theory. So like just trading, if you have the highs and lows for the year, it should be good. And then obviously in the in these periods, you're gonna use the highs and lows of the month, highs and lows of the week. Now I want to make another example on this. This was just to show you guys or give you an idea of what's going on. We do the same thing on DJ. Let me just load another template. So on GJ, same thing. Beginning of the year was this candle. So on GJ, same thing. This is the beginning of the year. This was a nice stop and low. Nice wick. Could have fought nice over here and went to the upside. And if you look at it as well, basically one, one, two, three pushes. The accumulation high formed, pull away. So if we actually flip this over to a 4 hour, you could see this as half of Batman. And this basically will become your straightaway trade with the crossover of the ketchup and the water. This will probably become your level one consolidation. This will be a stop hunt low to the neckline of the half Batman. So like I said, level one consolidation is usually a straightaway trade, which is quick. And once again, you see F1, 2, 3 pushes. which becomes your level 2 consolidation. And like I said, it always comes with some type of pattern as well, and it's the longest consolidation. So at this point, you can see that this was an inducing trend to keep people selling. And when they broke this point, you can see that basically just came to this point, kind of like a fake breakout and pulled away. And if you go back on the daily, you see 1, 2, 3 victors and start looking for your sales. So you could have sold from this point and sold from this point as well. That was dope. That was dope. That was a dope trade. So this would be level 3 consolidation. And as you can see, market makers never broke this point, this neckline, basically. They never broke this point. Potentially being because there could have been too much money to be released way up here. So this most likely becomes level 1 consolidation. And then you have 1, 2, 3 pushes to the low. And with the longest consolidation, 1, 2, 3. Like I said, patterns to induce. And once again, we have 1, 2, 3 pushes to the low. And this is our new low of the year at this point. So we mark this level up. So I would love to see them form the double information at this point so we can buy. I'd love to see something like this. Upside, or maybe a triple bottom, and then the way. And then maybe they can come back down if the EMA is somewhere around here, you know. But that's the next potential move I see on GJ. Just looking at what's currently happening. Also, if you look at the 4 hour, we see that there's kind of chopping up movement over here, and we have 1, 2, 3 pushes to the low. So I think that there's a potential they could hold this level. Could be a potential buy for us. So that's the quarter theory. Very, very simple. Like I said, high and low trading. I forgot to mention one thing. We are in the third quarter, which is June, July. So once again, like it's all psychological because look now what happens. They basically give us a strong impulse. Same thing basically happened over here, but just more fanned out. And we're still in the beginning of this quarter basically. So this could be a fake move, and we could see some upside on GJ. So that's what I'm seeing. And then for those of you that has been asking me about the order blocks. So basically, how order blocks work is volume, like I said in the beginning of the video, volume is found either at the high and low of the session, high and low of the day, high and low of the week, high and low of the month, high and low of the year. Never forget this. And also, the higher the time frame, the higher the volume. That's why I see, like, if you look at this GJ trade, like, at the high of the year, this is a big trade. Like, so this could also be this. If they hold this level and this is a W, we can we can we can expect about, if we buy from this point, we can at least expect 600 pips, 500 pips minimum. So get my point. Always trade. So I pointed out these areas where we can identify volumes as a trader. We trade from these areas. In order to catch these volumes, we focus on setups on the daily high and low. So on the template, the YH and the YH stands for yesterday's high and the YL stands for yesterday's low. WH, the weekly high, WL weekly low, MH and MI monthly high and low. So I'm sure you guys have seen the YH and the YL. You don't know what it means. It simply means it's the blue tracer. The blue tracer is the YL and the. So if you let me make this clear for you. Let's look at this. Okay, so over here you can see that. Okay, this was just this high. So obviously this was Spencer and Mayo, so you could have caught it straight, obviously. But I want to show you guys a more decent entry point. So let's say let's make an example. Okay, let's make an example at this point. We see that this was basically, let's say this was the high of the week. Okay, this was the high of the week. Let's say this is Monday. So Monday they form. Oh my word, really now. So let's say on Monday they form a high and they pull away. Cool. So if this was Monday, obviously this is the low of the week. Put in the line chart. So obviously now you have wicks for perfect W formation. So obviously this was a good trade. So London and New York reversal could have caught a sell as well. Nice. So this is the high of the week. So if the blue, like it says in the PDF, we focus on the pattern using the market method, and using the order as the order block as a sniper entry. So it says here somewhere, always trade outside of the blue tracer. I'm just looking for the example to talk about it. It is mainly trade outside of the blue tracer into the blue tracer from the high and low of yesterday or the previous days. So here's an example: trading out of the blue tracer and selling. It's good. Now here's an example: if this was a high at the high of the week, and we see over here they basically do 1, 2, 3 vectors, railroad track, the high of the week. There was a previous stop hunt box. Isn't that suspicious to you? That clearly says sell me. This clearly says sell me. And if you look at it even deeper, put it on the line chart, You have some divergence over here. You see the TDI also support you. So there's your entry point with a sharpen. So what requirements were met over here? You traded from the high of the week. You had a sharpen in the TDI, and you had divergence in the TDI. You had three vectors, railroad tracks. 5 of your requirements were met. You know, so if you trade after the stop is hit, just an example, if you waited for this to close and you entered over here, your stop loss would have been 17 pips. Your first take profit would have been 23 pips, 22 pips, and your second take profit would have been 27 pips. So in total, you could have bagged about 50 pips in this trade, no, say 45 trades, 45 pips, unless you yelled the whole trade to the low of the week, and you could have bagged about 50, 60 pips. Okay, so that's all I'm gonna drop for you guys for now. Focus on this for now. So, like I said, I'm gonna drop the link to my channel in the description. I'll drop the PDF in my channel if you want to get it. And then also, if you want to connect with me, any questions, just hit me up. So, simple things, have your highs and lows using your quarterly theory. If you just combine everything into one, you should be good. So, until next time.